So thank you very much for the invitation to present this paper in the conference. It's a pleasure to be here today, and I'm very much looking forward to hear the comments and also the questions from the audience. The paper that I'm presenting today, it's co-authored with my colleague from the board, Sharjil Haque, and with Simon Meyer from Carnegie Mellon. The usual disclaimer applies. The views presented in these papers are mine only and not at the Federal Reserve. So let me start the paper with quick motivation. As many of you know, private credit has seen quite a rapid increase in recent years. And this chart that you see on the slide comes from a recent IMF report. And as you can tell, private credit has reached more than $2 trillion in 2023. And actually, looking at current numbers, it's even higher, higher than 2.2 nowadays. A very large portion of private credit growth comes from North America, particularly from the US, and this is the red bar in the chart. But you can see also that there is a significant growth in Europe and in other parts of the world as well. So let me start by asking what private credit is. So what we mean by private credit, when we say private credit, we really refer to loans that are given by non-bank lenders. And what do I mean by non-bank lenders? I mean private credit funds and business development companies. Both of them are closed-end funds, basically, and most of them, but not exclusively, are sponsored by asset managers. So why is this important? Why do we care about this? Well, the size of the private credit market in the US, at least, is similar nowadays with the size of the syndicated loan market, with the size of the high yield bond market, and with the bank credit, the CNI loans. So we are talking a very significant portion of the credit market in the US. So, of course, this rise of credit, okay, has raised many concerns, and we have seen this in the media. This has been raised by policymakers and by practitioners at the same time. There is a concern that there is some migration from bank loans, from banking, to a very opaque private market. And so this is where this paper comes in, basically. So we are able in this paper to combine two pieces, the two different markets, the bank loan markets and the private loans markets, into one unique data set. So basically in this paper, we're going to be able to answer first, and most importantly, we're going to attempt to answer. I'm not sure if I'm going to fully convince you, but we're going to try to ask whether private credit is affecting bank lending. We are going to ask also whether private credit and bank loans substitute for interact, how they do they interact in capital structure, and also we're going to talk a little bit about firm level outcomes, such as investment. So now very quickly, what do we find in this paper? We find that almost half of the private debt borrowers also take loans from banks. We call this dual borrowers. And these private debt borrowers are large, are levered, have less assets that can be collateralized, and are typically in software, in service, in technology industries. Now, the second thing that we look at, we compare the loans that are given, the bank loans and the private debt loans that are given to the same borrower. And what we find is that private debt lenders usually provide term loans, whereas banks provide credit lines. In terms of characteristics, we find that private debt loans are larger, have longer maturities, are junior, and they are riskier generally than the bank loans. Then we focus on the dynamic of this market once the borrower gets access to private debt. So we examine what happens. And what we find, maybe surprisingly, is that banks actually extend additional credit, but mostly in the term of credit lines and at higher spreads. So we also observe that these credit lines are more likely to be drawn down during periods of stress. And so we conclude that private debt amplifies the bank role as liquidity provider in times of stress. So finally, our data allows us to look at, the firm level effects. The private debt issuance leads to an increase in firm leverage. It leads to an increase in the investment in intangible assets and actually stimulates the activity of the firm. So let me quickly go over the literature, and I'm not going to go over all the papers that we are connecting to. But of course, we are connecting to the literature, to the very recent literature that looks at direct lending and private credit. Of course, here we add a new angle because we are able to look at the interaction between bank loans and private debt. And also we are able to see how private credit affects bank loan performance. We are also connecting to the literature that looks at the interaction between bank loans and public bonds. Okay, we are adding here a new segment, a new type of credit, the private credit. And also we are adding to this literature that looks at the interaction between syndicated loans and indirect non-bank lenders, such as CLOs and bank-long mutual funds. And here, our angle is that we add new direct non-bank lenders because we are talking about private credit funds and business development companies. So let me talk a little bit about the data because it's quite an important feature in our analysis. So we collect our bank loans, our private debt loans, from PitchBook. And these loans and the information that we have about these private loans comes at the origination. So we know the loan size, we know the spread, we know the type of private debt loan, whether it's a credit line or a term loan. We know the deal purpose, and of course, we know the borrower name. The second source of information is the Federal Reserve Administrative data, the Y14 data, which it's unique because allows us to follow bank loans during their life from origination until repayment. Not only that it provides us with this information, which is very unique and very important in our setup, it also allows us to describe borrowers as well. So we have financial information on these borrowers at the yearly level. So we are able to combine these two data sets using the borrower name. So this is obviously a hand match that we completed over several months. But in the end, we identify about 5,800 private debt borrowers. And most importantly, we find that half of these borrowers, private debt borrowers, also take bank loans. And we call this dual borrowers. And we compare these dual borrowers in our analysis with a set of bank-only borrowers, and it's a very large number of those 65,000 bank borrowers that we identify in our sample. So we actually restrict the data to those that have a loan size greater than $5 million to make the samples more comparable in terms of borrower characteristics. In terms of purpose, this is one question that often comes up. What is private debt used for? A large part of it, of course, it's used for leverage buyouts, but private debt is also used for more general debt purposes and for other reasons as well, for refinancing. So we see quite a large variation in use. So let me start with a few firm level characteristics here, and we are able to compare in our data dual borrowers with bank-only borrowers. We are not going to be able, given the limitations of the data, to say something about private debt-only borrowers. So these are the only two groups that we can definitely compare in our data. And we find that dual borrowers are larger, are riskier, are more levered, and typically have less tangible assets. So if you look at the spectrum of bank borrowers, the dual borrowers actually are on the larger side, are riskier, and more levered. So this is the group that the private lenders are targeting. Looking at loans, this is a different level of detail in the analysis. We are able to compare in the data private debt loans with bank loans to dual borrowers and also to bank loans to bank-only borrowers. So we have three levels of detail here because PitchBook data allows us to tell something about private debt loans in particular. Doesn't allow us to say much about the private debt borrowers, but at the loan level, we have important information. So we find basically that private debt loans are larger, they are more expensive. The spread is 6 basis points compared to bank loans to dual borrower spreads, which is just 1.7 basis point. The maturity of private debt loan is also larger, and also private debt usually it's specialized on term loans. Now, of course, these univariate statistics could hide the fact that we are looking at very different market segments here. So the borrowers could be quite different in these three groups that I described. So to carry this out more formally, we do this in a multivariate framework. And basically on the left-hand side, we have loan characteristics, we have loan size, spread, we have maturity, seniority, and on the right-hand side, we have a dummy of whether the loan is a private debt loan or a bank loan, and a set of loan characteristics and other fixed effects. Very importantly, in our analysis, we use firm time fixed effects. So we are basically able to look at the same borrower that has both a private debt loan and a bank loan at the same time. So, so this identification comes from this set of fixed effects, and we also, in further analysis, we include fixed effects that relate to the loan type, whether it's a credit line or a term loan. So what we find, starting from the right, we find that private debt loans are more likely to be term loans and less likely to be credit lines. They have a longer maturity. They have lower seniority, so they are more junior in capital structure, and they are typically larger as well. We carry out this analysis a little bit further by including more detail on the loan type, whether it's a credit line or a term loan, and also we include in the analysis a dummy for the deal purpose, whether the private debt is used in a leveraged buyout or not. And what we find is that private loans generally are larger, even with all these controls into the regression, and they're more expensive. Now, when we are looking at the interactions with the LBO, with the purpose of the private debt, we find that generally private lenders extend less loans in LBOs, maybe because banks have a comparative advantage. But when they do, actually, they charge a higher spread. In our analysis, we find out that in this kind of cases, private lenders provide additional guarantees. They have additional collateral in place. So next, going to the most important question, I guess, that we'll try to answer in this paper: what are the implications for bank lending? And the first question that we're going to try to answer is, how is the access to private debt affecting existing loans? And this is an important feature of the data that we have at the Federal Reserve, because these loans in Y14, as I mentioned, are carried out from origination to repayment. So we can see exactly what happens with these loans at the moment when the borrower gets access to private debt. In our regression, which have loan fixed effects, so they are quite powerful, we can identify exactly what happens at the loan level. We find that actually banks extend more credit to these borrowers on all their commitments. So they provide more credit to these companies. The next question that you're asking is what happened to new banks loan, with the new bank loans. Are these banks more likely to extend new credit lines, new term loans to these private debt borrowers once they get access to private debt? This is a bank loan level regression, basically with bank year fixed effects. So basically we are asking, we are comparing the same bank loans to a given borrower before and after it taps private debt. And we find that after accessing private debt, banks are extending more term loans and are more likely to extend term loans, more likely to extend credit lines, but they do this at a higher cost, so the spreads are significantly larger. Then we, moving on to analysis, we show this in a time window around graphically, around the moment in time when the borrower gets access to private debt. And you can see immediately on the graph that the propensity of getting a new credit line increases dramatically once the firm gets access to private debt. And we show a similar impact on term loans, but at a lower level. Finally, you may wonder, the natural question to ask is, why do banks offer access to new and larger credit lines? And of course, there are several mechanisms here at play. There is a demand side. On the demand side, of course, once the borrower gets access to private debt, it expands operations, needs additional cash flows, new credit lines. So that's a demand view. On the supply side, what happens, two things could happen. There are two mechanisms at play here. There could be an insurance mechanism at play and a certification mechanism at play as well. So on the insurance side, what happens, as I mentioned earlier, private debt loans are generally more junior, have longer maturity. So basically, they provide insurance for the bank loans in capital structure. In terms of certification, banks feel more comfortable extending additional credit because basically these private debt borrowers, lenders are screening these borrowers and they are monitoring them over time. So there's a certification effect at play as well. So we are testing this supply side hypothesis in two different ways. So we look at lender reputation, for instance. We look at the top 20 private debt lenders, as being the reputable ones, as a signal that this mechanism could be at play. And also we look at the private debt loan amounts. So, and this is a signal that the private debt lender has more skin in the game. In both cases, we find that for both proxies, we actually find that banks are even more likely to extend credit lines and term loans when the private debt lender is more reputable or when it has more skin in the game. So these regressions here show the propensity of giving this additional credit is higher in these cases. And we also have a similar kind of mirror image in terms of the amount. So the amounts are also larger as well. So we conclude that while the private debt is substituting for bank term loans in the capital structure, they also amplify the bank's role of liquidity provider through the credit lines, because they provide a lot more credit lines than term loans in the capital structure of these dual borrowers. And we complete this analysis by looking at a liquidity event, COVID, as it turns out in our case. And we compare here the utilization of credit lines for dual borrowers that have both bank debt and private debt versus bank-only borrowers. And we find that dual borrowers actually draw down a lot more of the unused capacity during COVID. So they expose the bank to this drawdown risk. And this can be a substantial risk for banks. We do this obviously in a more formal setup as well, in a multivariate framework. And what we find looking at the coefficients is that dual borrowers actually use 4% more of the unused capacity compared to the bank loan borrowers in the case of distress. So we conclude that financing dual borrowers exposes banks to liquidity risks. Then the final part of the analysis looks at the firm level effects. So what do firms do with private debt? What do they do with this additional bank credit that they obtain? And what happens with their capital structure? So looking first at capital structure, we find that these firms become more levered. So the ratio of debt to assets actually is increasing after access to private debt. The amount of debt that they undertake is also larger, and the ratio of bank debt to total debt actually decreases. So the importance of bank debt in total debt actually decreases for these dual borrowers. And mechanically, of course, the ICR, the interest coverage ratio, goes down as well. In terms of real implication, real outcomes, firm outcomes, we find that the sales are growing faster after access to private debt. There is no impact on capital expenditure. There is a little decrease in the relative investment in fixed assets, and there is more investment into intangible assets. And these firms actually hold a lot less cash in their capital structure, on their balance sheet. To conclude, I think what we document in this paper is that banks and private debt lenders often work together to co-finance deals. Private debt lenders provide larger loans, riskier loans with longer maturity, and PD loans are also larger and have higher spreads and longer maturities. When the bank borrower taps into private credit through private debt, we find that banks actually increase the amount of credit lines, they increase the amount of commitments to these borrowers, but this extension of credit is actually costly. During market-wide distress, and this is another angle of our analysis, we find that dual borrowers actually use a lot faster their unused capacity, and so they expose banks to liquidity risk. And finally, we find that at the firm level, we see the impact on leverage, the impact on the sale growth, and so forth. But bottom line, I think the message that we want to leave at the end of this paper is that private debt substitutes for junior term loan, junior long-term bank credit. However, it amplifies the liquidity risk of banks in this process. Thank you.
Wonderful. So yeah, let me also start with thanking the organizers to giving me this opportunity to discuss this really insightful and also very relevant paper. And even though I think that Irina gave a great job in presenting it, let me also shortly give you the overview of my reading of the paper. So what Irina and her co-authors are doing here is to study how private debt and bank lending differ and how do the two of them interact. They look at how the growth of the PD lending overall affects banks. Do PD lenders in banks actually compete, or do they complement each other? And the paper also touches upon some important financial stability implications for the banks. So how do they do this? They have this wonderful combination of two key data sets, the pitch book data on PDs and official sector bank data from the Fed. And as they have then this borrower information in both data sets, this allows them to match the data on the borrower side. And when you then want to understand the difference between bank loans and PD loans, this allows you for a very clean identification because you can control for all time-varying borrower effects. And I think this is really a very nice way to go. And when doing this and comparing PD loans and bank loans, the major insight is, I would say, that PD loans tend to be riskier. So they are larger, they have higher spreads, they are typically term loans, they have a longer maturity, and they tend to be more junior debt. Moreover, when receiving PD funding, borrowers tend to obtain actually more bank loans, and especially in the form of credit lines. So this speaks to this fact about complementarity versus substitutability of the two. And then on top of this, these effects of additional bank involvement, these effects seem to be stronger when the PD lenders involved are larger, so have a higher reputation, or when they provide larger loans, so when they have skin in the game. At the same time, and now we are coming to financial stability, they also observe that during market stress, there's an increased drawdown by PD lenders on these credit lines, and also the default risk of the borrowers involved are increasing. So this implies that there can be some trouble for the banking system in form of higher liquidity and credit risk. And finally, they also even look at the borrower side. And when they do this, they find results which are very consistent with the other analysis, namely that the borrowers involved that are PD lenders at the same time, they have higher leverage, They have more bank debt, even though the share of this bank debt is lower, lower interest rate coverage ratios, and the proceeds of this additional borrowing seems to be used to grow and to invest. Yeah, and overall, I think this paper is really great, and I think Irina told me they only finished the first draft earlier this year, and I think despite this, I found the paper extremely clear messages, very well executed, and I think what is often said about the sector is that it's described as opaque and there's little data, so also in this respect, I think this is really a great contribution to shed more light on that. So what I want to do in the following few minutes is, first of all, put the PD sector developments into a bit wider perspective, let's say, and add some thoughts what could also be done beyond this paper. And then also I will have some additional thoughts on the paper and the present analysis. Let me start also with some stylized facts. I can be short because I took a chart here on the left-hand side from the same report that also Irina used. Because of this massive growth in the sector, also policymakers became quite interested in this. So the left one, just to recap it quickly, because I think it's really striking, shows you that in the US markets, the PD market has reached the same size as high-yield bond markets or leveraged loan markets. So it's nothing you can ignore anymore, and I think it's really of macroeconomic relevance. At the same time, also the ECB looked into this, and this chart here on the right-hand side is taken from the last ECB Financial Stability Review from May, and there you can see very clearly why this is large in the US very much. This is not at all the case in Europe, and even in the United Kingdom, which is just from being an economic area much smaller, this is much larger there. At the same time, we also know that also economic dynamism between the US and the euro area can be quite different. And there's actually a high number of people arguing that this lack of these types of funding, like PD or also private equity, which is quite related, this can be one of the reasons about the differences in these growth differentials or also economic dynamism between the regions. And how is that? When you look at the sectors involved in PD lending, so what are the borrowers behind? And Irina has very similar data in her paper, but this chart here is also taken from the IMF. You would find that sectors that are more relevant for economic growth and technological progress, they tend to be overrepresented when it comes to PD lending. So as she said, information technology, software, corporate services, healthcare, these kind of sectors. And so going a bit beyond what you do in the paper, because I think your data set can in principle allow for that, is to maybe drill a bit deeper also on the firm side. So I know right now you only have 11 years of data, but maybe going forward you can also track these dual borrowers over time and compare them to bank-only borrowers. Do they indeed also grow faster over time? Do these effects depend on the sector involved? And can you also say something on the innovation capacity of private debt borrowing firms compared to others? And I think if one can substantiate this claim that PD lending may actually help financing innovation, I think this could also change the perception of this sector quite a bit, which I think at least in Europe can be quite negative. Then going a bit more directly into your analysis, and in particular on the aspect how private debt lending affects bank lending. I think one key result that you're highlighting is this complementarity between PD lending and bank credit lines. But you also speak of substitutability, so in the sense of competition between standard term loans from the banks and the PD lending. And I think it's very intuitive and straightforward that, let's say, in partial equilibrium, there must be this competition between these two funding sources. But at the same time, from looking at your results, it seems to me that in terms of direction, the term loans would also increase in the same direction as the bank credit line once a borrower gets involved into PD lending. And so this speaks to me a bit about that, and let's say in wider effects or general equilibrium, there is also something more to it, and it could mean that the presence of the PD segment is not so much actually in competition to the banks, but it's more like a win-win and more business for everyone. And I think if you can clarify this a bit more in the paper, I think this could be helpful. Another aspect I wanted to touch upon is the relation between the banks and the PD lenders themselves. So what you show in the paper, and which is, again, I think very intuitive and reasonable, is that bank lending to dual borrowers increases more when the PD lenders involved have a higher reputation or more skin in the game, as you say. But maybe there's also a way to look a bit more directly in this, in the sense of, is there already a lending relationship or some other relationship between the PD lender and the banks in the sample? And maybe this could explain this increase in the lending even more, because they know each other. And related to that, I think PD firms often, or PD funds often, relate themselves to private equity companies, which are very well connected in the wider financial system. So this could also explain this relationship here. I know it, of course, depends on data availability. Then another aspect I found very interesting is using this SVB failure as an aggregate shock to bank credit supply. And I think that's a very good idea. And they use this also to make this point, or to study whether there's competition between the banks and PD lenders or not. But I also thought maybe one can make use of this even a bit more, given the fact that SVB, from its business model, is was quite involved with innovative firms, or as they used to say by themselves, they saw themselves as the financial partner of the innovation economy. So it could be that these PD borrowers in your sample were also actually borrowers from Silicon Valley Bank. And if this is the case, and you have SVB in your sample, obviously, you could try to separate a bit the direct effect from SVB dropping out. And this would tell you something about also this, let's say, partial equilibrium competition effect versus the wider indirect sector effects. And yeah, maybe that's also an interesting addition. And then more generally, as a last small point, I think we learn a lot in your paper on the borrowers involved, on the PD firms involved, but maybe you could add a bit more information on the banks that you have in the sample, and in particular those that are involved with the PD business. And I think I have exhausted my time, and let me stop here. Many thanks.
Thank you, Christoph, for a very nice discussion. So yeah, so we collect a few questions and then we pass the floor. You may come here, but it's easier to talk now. Yeah. Okay. So one there.
Thanks, Irina, for a super interesting paper. So maybe that's more an observation. So it seems that this is somewhat similar to the syndicated loan market, where for the leverage lending, especially, where the non-banks fund the leverage loan and the credit line sits on the bank's balance sheets. But there is a common credit agreement. So both the credit line and the term loan sit together, and there is a leader arranger that typically sits on both. While here, it seems that these two products are separate, and then like the lead arranger share would be playing more monitoring, would give incentives for monitoring. But here I wonder how the bank monitors, like if there's this disaggregation between the private credit and the credit line. Doesn't that make the credit line riskier in some sense? Because there is no common agreement and they're not connected. And the other thing is, maybe it's hard, but I wonder, these credit lines, are they solo credit lines, or they're maybe shared with other banks to perhaps respond to the higher risk?
Thank you. Then okay. Thank you. Then Angela, and then Bruno, and then John. So Angela.
Hi. So it's a bit my question linking to what Teodora was saying. I mean, I have to say it's very interesting. I have some difficulties reconciling some of the results, especially regarding the credit lines. So the first observation is also something Christoph has mentioned. I wonder what kind of institutional linkages can there be between the banks and this private debt institution. Because, there is a literature and, I mean, this fact that basically the borrowers get bank loans afterwards. I have in mind that maybe there is some linkages like in banking groups or some other sort of linkages. And then related to the credit lines, I wonder if regulation somehow plays a role here. So maybe, I mean, these credit lines are shared or something like this, and somehow this has some sort of advantages for the banks.
Thank you. So first there.
So I have the advantage that I saw the paper already, but I think it has been improved. And the narrative, it's a lot on the lender side, right? The impacts for bank lending. I was thinking about the borrower side. Why would a borrower go to the private debt market if they have already access to traditional bank lending? So I was thinking about two stories. One, is this like financial constraint story? They reached the limit to how much they can borrow from the bank, and they need to go to a private debt lender. So overall, ceteris paribus, this increases potentially the risk in the financial sector because you're providing lending to a riskier firm, whether they make it used for productive uses or not. So we don't know. They were not increasing capex in your regressions. The second story is innovation that was mentioned in the discussion. So these are firms that cannot pledge the collateral because it's for intangible assets. The reason why you don't find anything in your regressions on capex, they maybe increase intangibles, and it's difficult. You cannot pledge this for a traditional bank loan. If you can elaborate on these two stories or an additional one. Thanks.
Okay, then Jean-David, and then Philip, and then okay. So 1, 2, 3. So first, start here.
Just a quick question. So those private investors, they probably do due diligence. Is there a way to understand whether the banks, when they give an additional loan after the PD, sort of free ride on this new information or utilize this new information in a way or another? Thanks.
Thank you. Then Philip.
Thank you. I just had a simple terminological or perimeter question. So, so you talk entirely about what you call private debt. And I wondered how that integrates in the wider range of non-bank credit or non-bank debt. So first, so what you call private debt funds, is that what in our statistics often called credit funds? Is this identical, or is this a subset of that, and what's the difference in case? And the private debt, I was wondering whether, so say take as another category, private placement. So that's another category, differently done, that the syndicated loans were mentioned. So it would be interesting to see the scope of this particularly private debt compared to this whole range, and then see its importance and growth rates, whether this is something US specific or whether on other categories and other constituencies this would evolve. So I think it would be good to see this kind of together to further assess the relevance of this. Thanks.
Thank you. Then please, just next.
Hi, my name is Nicholas Smith. I'm from the Alternative Credit Council. We represent credit funds. So first of all, the paper's really good. It's an area I've not seen literature on before, so well done to you and the team. The pitch book data you use, that's very much US focused, very much private equity sponsored focused. So I wanted to understand how you and your colleagues sort of controlled for that when trying to extrapolate that across the universe, and whether you've seen any differences in, say, European related borrowers versus US related borrowers when you're looking at this. And then just a quick advertisement. I'm publishing my annual research paper this afternoon, so I'd be very happy to talk to you and others about that as well. Thank you.
Thank you. Any other? Yeah.
Thank you. I had a very similar point to Bruno, but just to add to that, right? So is it a market segmentation effect in which, okay, I can't go to my bank, I'll go to the private credit? The second one, is it a pricing thing? So is it maybe I get a better price if I were to private debt? And the third one is it actually a diversification story, right? Thinking about your mechanism that once I go to private debt, then I'll get more credit lines from the bank. So is it kind of an ex ante, I want to diversify as a borrower, and that will actually improve, if you will, my credibility and my future prospects of doing other kinds of business with other lenders? Thank you.
Thank you. Any last question? Everybody happy? Okay, so Irina, you can take a good 5 minutes because you got a lot of questions, but you see that the topic is enticing.
So thank you so much. Thank you for all the comments. This is great. This paper has a very short life, so we are still improving. As this is, we haven't presented it as often. So, and there are several angles here that you all brought up that are very interesting, and we are still looking at them. So I like the innovation kind of angle that you brought up. I think maybe there is a good side, to this market. Maybe it's gonna bring up more innovation. We haven't really pushed along those lines, but I do like the idea of kind of going into this direction and maybe following up these borrowers over time to see how they perform. We show in the paper, but I haven't presented today. More information on the substitutability on term loans by using the Silicon Valley Bank as an event. And we find substitutability on term loans on the junior side of term loans. So I think, they complement each other. The private debt and bank loans complement each other maybe on credit lines, but on term loans, they kind of compete with each other on the riskier tranche. Now, there are definitely connections between banks and private debt lenders that we haven't fully taken advantage of. Many of these borrowers have PE backing, but we actually account for this in our specifications because we have firm time fixed effects, so that implicitly controls for the type of backing they have, but there are connections between lenders and banks that we haven't fully explored, but we are actually doing it as we speak. We'll talk obviously more about the banks in the sample. This is we are covering the banks that are covered by Y14 data. So we have 35 banks that cover a significant amount of bank loans in the United States. Now, there also, in terms of credit lines, there was a question about whether it's provided by one single lender or by several lenders. We do have club deals in our data. Again, we control wherever we can for these club deals, where club deals are more like syndicated kind of loans in the way that I guess we think about in the syndicated loan markets, but here it's in the private debt space. So we have a little bit of syndication here going on, which we try to control for, but and it's a small kind of percentage we feel like in our sample at this point. Why do borrowers go to private debt lenders? Well, there are many reasons for which they may. I mean, the private lenders provide a lot of flexibility. They act very fast, a lot faster than banks. So maybe borrowers see an advantage in this flexibility and rapidity kind of deal making. Many of these borrowers actually are in this service and technology industries, right? So some banks are oftentimes reaching their lending limits with this borrowers. So there is a regulation in place here, so they cannot go over certain leverage ratios. And this is when the borrower actually prefers to go to a private debt lender. So there are many explanations that could, lead to kind of this result. And private lenders also use as collateral cash flows, not fixed assets. So it's a combination of things at the end of the day. Relative to the question of whether private credit funds and private debt funds are the same thing, yes, they are the same. We use them interchangeably in our presentation. We don't talk about private placement. We agree that that's an important angle, but we don't have data in that regard. And I don't know if I missed something else, but yes, thank you so much for all your comments. Very much appreciated.
Thanks. It was a really interesting session. Thanks everybody for participating actively. So now it's time to taste the wonderful food of the ECB. So we come back at 2 for session 2.